Welcome back, folks. This is part 4 of the continuing series of the ICT Optimal Trade Entry Pattern Recognition series. All right, so now we're going to look at a Forex pair, the British pound versus the US dollar. And this is going to be an example of a trendless market where it's not really dependent upon a specific daily bias. And we're just using intraday volatility to find an optimal trade entry. But before I get into it, I want you to take a look at this chart. And I want you to think about what the neophyte or the new trader that's just being exposed to what I teach, or someone that thinks they've been around the block a few times and they think it's just something being renamed, rehashed, reinvented to try to take credit from some old guy that's buried and long since been forgotten. Look at this chart. Now, classically, people will say, well, it's just support and resistance. And old highs and old lows where the market's turned before, that's all you need to do. Look for those points. And when I first started, I read the same books these people do too. And I can tell you that if it was just that simple, everyone would be billionaires. Okay? It's not support and resistance that leads to Forex riches. I needed to find out what was really going on. And when I did, all these ideas of support and resistance levels faded away. And I got to the real heart of what turns the market and then why the market should react at specific price levels. So now I want to kind of show you what it is. And it's something that you guys are familiar with if you've been looking at my content for any length of time. But let's go to another chart. Now I'm going to add the perspective that I teach my students. This is the market efficiency paradigm, okay? And what is that? It's basically the narrative of why price goes where it does and why it reacts the way it does once it gets there. And where is it reaching to next? Okay, so this particular candle here cuts to the whole narrative immediately. And the reason why is you want to look at price and look for areas where they run an old high, because old highs right above that is going to be buy stops, and that's what buy side liquidity is. Buy side liquidity could be in the form of buy stops for new entries going long, or it could be buy stops protecting existing shorts. The market rams through that, and this action right here is what I teach as a Judas swing. In other words, it's a fake move. It's to lull people into thinking that the market's going to be bullish, it's going to go up. But generally, when we see these sharp moves that run previous highs, this to me is highly suspect. And if we get back below the lowest down close candle, once it breaks that, which it does here, the narrative changes to bearish. So all I need to do, and my students do, is we go to this candle here, draw it out in time. There's your turning point. That's your real support and resistance level, because it's based on the market efficiency paradigm. That is mine. You're not going to find that in books. You're not going to see any of that anywhere outside of what I teach. And there's a lot of things that go along with this pattern. Too many people go on YouTube now and talk about the ICT breaker, or they just remove the ICT and they call it something else, a banker's candle. You know, everybody's got a new twist on what I'm teaching, and they don't know what they're talking about. What I'm showing you here is the narrative behind finding an optimal trade entry with this structure in place. It's a trendless market environment. It doesn't have to have a bullish or bearish bias on the daily chart. So you go into lower time frames, and this right in here is what we're going to zoom in on. Okay, so we're going to look at the lower time frame 5-minute chart right here. Okay, but before we go into it, since we're on the hourly chart, I want to annotate the previous day's range. Okay, so we have this as the beginning of the 11th and the 12th, which is the day of this recording. And if this is going to be a breaker that's bearish, we're going to be looking at previous day's low. That's where we're going to be targeting. So the liquidity that would rest below that, that's what we're really aiming for. So we're going to drop down to a 5-minute chart in this box here and get a closer look as where the OTE forms. Okay, so here's the 5-minute chart on the British pound versus US dollar on a 5-minute chart for May 12th, 2020. And here's trading up into that area I outlined on the hourly chart, where we can see that breaker. Price trades up into it, and this old high, returning to it here, it hits the same level Again, it's the breaker. It's not the classic support and resistance. It's not the supply zone. It's none of that stuff. Okay, it's the optimal trade entry. Okay, and we'll project this out in time. Okay, so we have the high to the low, returns back to optimal trade entry, 79% retracement level lays right on top of that level here. Your stop will be above here. And the market raids an old low here, and the fib level is here. So you could use 123 big figure as your level, not reaching for the fib, because the magic is not the fib, but reaching below this low for the liquid that resides below here. Now, this is the previous day's range, okay, to the 11th. We also have more time here in our New York session to look for another trade if it forms. Has it taken out previous day's low? Not here. It starts to retrace on this candle here. What time of day is that? 11 o'clock in the morning. That is still time to take another trade, and if it's still there, if it's valid. All right, so we can see the optimal trade entry here. Low and high, retraces back into the New York session, and previous day, or the 11th of May's low. We will be targeting that next. Stop would be above here. Your short would be in here at the 62% retracement level. And again, below the level of the previous day's range low at, what is that, 122.83 and 1 pipette. And then the next fib level would be 122 and 65 and 5 pipettes. So we will be looking for this as a potential objective, but we can just simply use the 122.70 level. It would be below the 11th low and not demand a full fib. Now you can do that, but in this example, we're sticking to the rules, rounding down and being content. And the result of this is here. The market trades down to the standard deviation of 1 on the range, and we blow below the 11th low. Sweep it here, work on it here, and then expand down. So again, this is another example of the optimal trade entry, and this is video number 4 in a continuing series of 20, and I hope you found it insightful. Until next time, I wish you good luck and good trading.